Now, if you ask me, at what stage would you put 100% into gold? I have to say I'd be tempted, or I'm always tempted to do just that, because I can't see how stocks would perform well, because stocks are driven by money printing, and gold wouldn't do well.
In a recent interview on Live from the Vault with Andrew Maguire, Marc Faber, the publisher of the Gloom, Boom and Doom report, shared his perspective on gold and the current economic and financial landscape. Faber is known for his bearish outlook on the global economy, and he has been warning investors about the risks of inflation and economic instability for many years. He believes that gold could potentially reach a price of $3,000 per ounce within the next few years. During the interview, Faber emphasized that investing in gold might be a preferable choice compared to investing in stocks. He reasoned that stocks could be adversely affected by the increased printing of money, potentially resulting in underperformance. Faber also mentioned that gold experienced a period of correction after reaching a high price in the past. However, it subsequently remained within a certain range for an extended period before starting to climb again. Additionally, Faber believes that if the US dollar were to collapse, assets like gold, silver, platinum, and even Bitcoin could increase in value. He argues that the printing of more money by central banks is a major cause of inflation, and he believes that this could lead to a collapse of the US dollar. If the US dollar were to collapse, it would have a devastating impact on the global economy, and it would likely lead to a sharp rise in the prices of assets like gold. Now let's watch excerpts from Marc Faber's interview with Andrew Maguire. Be sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
Personal responsibility is, of course, not affordable for everyone, because it not only entails holding gold, but it would entail holding, diversified portfolio of assets. So you would have some real estate and some stocks and some cash and some gold and silver and platinum. But you would have to also then diversify the jurisdiction. In other words, you would hold some gold, say, in Europe, but maybe some gold in Asia, and so forth and so on. So someone who is poor, he has more difficulties to implement this strategy. But in general, I would say you shouldn't trust government officials, and you shouldn't trust central bankers to look after the store of value function of money, because we know, and is statistically proven, that the purchasing power of money has gone down a lot. I mean, if you look at the documents at what prices your grandparents bought their house or their apartment or condo, what it is worth today, you can say that money has lost its value. And it is quite possible that this loss of value will dramatically accelerate. That I want to state. If we look at the Roman Empire as a model, for the first, say, 300 years, the value of the dinar went down a little, but not much. But then it was like a watershed and waterfall, and it collapsed. So this could happen to the US dollar, and that would obviously propel assets such as gold, silver, platinum higher. I want to make one point very clear to the people that I meet at conferences. So many people always tell me, oh, I don't trust anything. I put all my money in the bank. Money in the bank is no longer safe the way it was when my grandmother put all her savings in the bank, because the banks are no longer safe, and the monetary depreciation, or we can call it the monetary inflation, is very high.
Moving forward, Marc Faber is also concerned about the rising level of government debt. He believes that the recent debt deal, which increased government debt by trillions of dollars, will lead to inflation. This is because governments have to print more money to cover the deficit, when they spend more money than they collect in taxes. This increased money supply can lead to inflation. Faber expects that inflation will hit different assets in different ways. He highlights that stocks will be one of the hardest hit assets, as rising inflation will erode corporate profits. Bonds, on the other hand, may actually see their prices rise, as investors seek a safe haven from inflation. Commodities, such as gold and silver, may also see their prices rise, as investors use them as a hedge against inflation. Let's get back to the interview.
When I talk to stock people, they all say that my allocation to equities is too small, because my allocation to equities is 25%. But then I tell them, well, I have also 25% in real estate and real estate related equities like REITs and so forth. And then when I talk to bond people, I say I have 25% in cash and bonds. They think it's too little and so forth. When I talk to gold, some of my gold bug friends, the truly hardcore gold holders like Eric Sprott or Tom Kaplan, I think they have most of their money in gold and gold assets. I mean, I have about 25% in gold, but it's quite a lot. When you have central banks and governments that can pile up deficits and print money, it is clear that somewhere in the system, we don't know where, but somewhere in the system, prices will go up. Now, these price increases can be in stocks, they can be in bond prices, they can be in commodity prices. They are most of the time somewhere in real estate prices, but irregularly. And they can be in consumer prices. I don't think inflation will come down in the next 6 months. Then central banks will say, hurrah, thanks to us, we brought the rate of inflation down. Because of Putin, it's because of whatever. But now that inflation will come down somewhat, they will say, it's us in our intelligent battle against inflation. Anyway, but afterwards, in my view, inflation will accelerate, and it has to, because you look at the recent debt deal. The recent debt deal will increase the government debt by $4 trillion in 2 years. If it's not financed by taxation, but it increases the debt, in other words, it's a deficit. A deficit is inflationary in any instance, because it increases the spending more than the tax revenues that would support the spending. So my view is, if we talk about inflation, the picture doesn't look good. And in history, every messed up regime, messed up government has always found the creation of inflation to be the easier option than the curtailment of entitlement programs.
Inflation is a major concern for many investors, and it is one of the factors that could drive the price of gold higher in the future. As inflation rises, the value of paper currencies decreases, making gold a more attractive investment. Gold is also seen as a safe haven asset, meaning that investors often turn to it when they are worried about the state of the economy. If inflation continues to rise, it is likely that the price of gold will follow suit. What do you think about Marc Faber's perspective on gold? Do you think he is right to be concerned about inflation and the future of the global economy? Please share your comments and observations in the comments section below. Additionally, if you found this video informative, don't forget to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.